into the next year is to concentrate on things that you have over control, right? If you said obviously 2, right? If you said 2, or you said we're going higher, or range bound, okay, 30% of cash is possible, right? Okay, at least 30% in cash. If you said, we're going lower, we're going to break new lows, then I propose 50% of your cash, right? You turn on TV, and there's two, it's divided into 2 camps. Some people say start buying. Some people, no, it's too early. But all of them says keep your dry powder, what's the expression? Keep your dry powder on. The point is keep your cash, right? Because nobody knows how low we're gonna get. So whether we're gonna reach 52-week low or we're gonna break 52-week low, the idea is that you need to have cash, right? So that is the most important decision. So when you trade, right? If you trade stock, it's kind of easy, right? You have, this bucket of cash, right? Or account value, right? So let's say this is cash, right? Half of your portfolio is in cash. Half of your portfolio is in equity, right? Right. Most of you guys are stock traders, right? Very, less than half of your option traders. So you basically say 50% cash, right? Half of my bucket of account value is cash, 50% in equity, right? And then, if you think we're gonna break the lows, then maybe try to, buy some hedges, right? SH, right? Something inverse, PSQ, maybe this 50% of equity, you do some kind of, maybe 5% or 10% of that, depends on your views. You put SH, PSQ, maybe UUP, right? UUP is $1, right? But that's how you hedge. And 50% you keep in cash, right? Because it's almost universally accepted right now that, you should have cash, and as market drops, you use dollar cost average, right? Everybody's talking about, you turn on TV, everybody talks about dollar cost average, right? Market reaches 52-week low, you take 50% of that cash, I don't know, take a third of it and you deploy, right? It drops another 10%, take another third and deploy. But always keep cash, right? Always keep cash because you need it in case market does drop below 52-week low. So that's a very important rule, cash, right? If you buy on margin, or if you buy options, right? This is equity. What if it's an options or combination of options and equity, right? I propose the same thing, right? If you're trading, 50% cash, it doesn't matter what you trade. Bitcoin, futures, futures on futures, options on options on futures on futures. It's cash is cash, 50% cash. Here you can say, half of my stock, half of my, 25% of my account value is in equity, 25% is in options. Okay, that's fine. I encourage you to keep options as cash secured puts, right? So if you trade in, if you have $10,000 account, right? If you have $10,000 account, only trade $100 stocks, right? And when you buy one contract, right? When you buy one contract, you basically always translate. In each contract, there's 100 shares, right? Strike price is 100, right? So I'm already trading $10,000, right? $10,000. Granted, this one contract maybe only cost you, 2.5%, $2.50, but you always, this remainder in equity, right? You always treat option as equity, right? You use either cover calls or cash secured puts, but you have cash to cover that, right? If you don't have cash to cover it, the other calculation, you basically say, okay, I don't want to risk more than 10% of this bucket. So let's say this is 25% and this is 25%, right? So I would not risk more than half of that, right? So you take this half, right? I always say 10%. When I say 10%, basically both equity and options, right? So on the $10,000 account, you never risk more than 10% of your account value, right? So we had, draws, every pullback is about 20%, right? If you go back this year, and you probably don't want to assume any other ways, right? So if you look at these pullbacks and you measure them, right? So okay, we have pullback number 1. 12% in January. Okay. Then we had 17%, in March, April, and then we had 12%, and then we had 19%, and then now we are already down 8%. Let's assume it's another 15 retest or even make new lows. Another 20% lows. So the point is that every time you have these drawdowns, drawdown 1, 2, we have major sell-off 1, 2, 3, we're on the 4th major sell-off, right? So imagine you're losing more than 10% on each of these sell-offs, then you're down 50%. Very hard to recover from 50%. If you're down 20% on each of these drawdowns, then you're probably not trading anymore. So going back to this diagram, right? Basically, you have to say, okay, assuming we're going to have a 20% drop down, right? So either we're going to hold the 348 and you're going to exit out your long positions, right? So at this point, you're going to be down 10% across all your positions, right? Or we drop 20%, right? You're not going to hold, you're only going to be down 5% here, right? And you basically say worst case scenario is going to be, similar, drop as we had here, right? So that's 20% drop. That's 320. So then your stop loss is here, and then, you're down 10%, right? So no matter what, you can say 2. For those of you who said 2, if the market drops at 350, you do not want to be down more than 10%. For those of you who said that lows will not hold, it will make new lows 320, then your stop loss, you don't want to be down 10%, right? So when you look at your equity, right, if you have 20% pullback in your equities, right? If 50% of your portfolio is in equity and it dropped 20%, well, that's 10% of your portfolio, right? Then you can't really have any options, right? So that is the most important calculation, right? You kind of look into the future. You have an opinion whether this level will or will not hold, and if you think this level will hold, then in case you're wrong, 10% is at the risk, right? If you don't think it's going to hold and you still want to be some bullish, some bearish position, then at this level, you do not want to be down more than 10%. That is the most important decision you can make going into the next year. How much cash you will have, how much equity you will have, how much options you will have, and make sure you're not over leveraged, right? You're not over leveraged, right? And if the market is down 10, 20%, you're not down more than 10, 20%, right? You're down less, right? But because you have hedges, if you trade in stock, consider buying SH or PSQ. If you trade in options, consider buying QQQ put spreads or Spiders put spread, right? So portfolio allocation, cash is very important. The second is number of position and position size, right? 2.5%. And especially for options trader, right? If you're a stock trader, maybe you can have a little bit more, but for options traders, you have 4 positions, you're risking 2.5%. That means in any given moment, if the market pulls back 10 to 20%, you are not down more than 10%, right? That's the goal. If you're down more than 10%, especially if you have multiple of these waves, that's when you basically stop trading. Another important concept is, we talked about ABC pattern. During sell-off, wait till end of days. That's not as important right now. Give yourself more time, right? If you think market is going to sell off in February, January, buy March contracts. If you think it's going to sell by March, buy June contracts, right? But give yourself more time when you're trading options, right? Because, and then give yourself more space, right? If you answer 2 right now on the next 6 months and you think 52-week low will hold, just assume we will make new lows. So that means you're reducing your position size. If you're going bullish and let's say market drops a couple %, you say, okay, I think 52-week low will hold. Just give yourself a little bit more space. Put 5% below 52-week low, right? And then that will force you to buy less shares or less contracts,